Well, the two-front trade war has investors looking to the Fed for some reprieve. Fed funds probabilities now pricing in an over 70% chance of a rate cut in September. Barclays and JP Morgan saying today that they are both now expecting 2 rate cuts this year. Actually, I think Barclays said 75 basis points total. So Jeff Mills has a chart here that suggests a rate cut might not be the savior that stocks are looking for. This is our chart of the day. Jeff, why don't you explain it?
So every piece of fixed income research I saw in my inbox today said the probability of a Fed rate cut has gone up. And I think there's a camp of investors that believes that the Fed can step in, even if things get worse, they will cut rates and things will get better. And I think on the surface, that probably makes some sense. You saw interest rates go from 2.75 on the 10-year down to wherever we closed today, 2.13 or 2.14, and stocks are up about 20% since Christmas Eve, maybe a little bit less now. But on the surface, that seems good. Low rates, that's good for stocks. But if you look at this chart and you look at the individual trading days, really what you see is on the up days for rates is when the S&P has actually made most of its gains. On the down days for rates, the market's actually down about 8%. So it's not all that clear that the Fed stepping in is actually going to be the savior that everybody thinks. So I think it definitely calls that thesis into question. Maybe bad news is bad news now. We've been conditioned for bad news being good news because of lower rates. I'm not sure that's the case anymore.
The Fed was stepping in all the way down in 08. And I mean, stepping in, that's going to scare the market.
Right.
I mean, at this point, now there's more confirming data around the world that maybe the economy is, in fact, soft.
So if you think about the time lag between the last Fed hike and the first Fed cut, it's not as long as a lot of people think. And it looks like the market is telling us where the Fed is going to have to be, whether the Fed is going to deny this or not. Ultimately, if the Fed is cutting twice in 2019, it's not good at all for markets. And even though some people thought the Fed was overly onerous in terms of where they were in the fourth quarter, this is a sign that the economy is weakening much more aggressively than they were telling us even 3 months ago.
Yeah, I'll just make one last point. I think all of us, other than our friend Jeff here, is a little too young. Remember what it was like in 01 when the Fed started cutting rates in a surprise fashion. And then again, maybe in 08, you might remember that. But, you know, it was the sort of thing that causes a near-term short squeeze. But at that point, these were desperate actions in crises. And the fact of the matter is, we don't have a crisis right now. What's the crisis? You know, the stock market is at an all-time high. Larry Kudlow goes on TV just last month saying the market, the economy is killing it. Where's the crisis? So if they start cutting rates off of Fed funds at 2.4% or something like that.
But they're in preventive mode. I mean,
well, yeah, but then, so then where do we go, Mel? Because with inflation at 2%, we basically have we're at zero. So then we're going to start getting creative. We just had 3% GDP growth in Q1. We're going to start panicking on quantitative easing on things that we've never seen before when there's no financial crisis.
No, but what you just said, though, is important for people on a Friday where it was another awful week. I don't think there should be a panic out there because the economy is not going straight over the cliff. Equities are priced near perfection still, and that's really where the equity market is making some kind of an adjustment.